For years, crypto was sold as an escape from the dollar. No banks, no borders, no central government controlling the money. But while everyone was waiting for crypto to replace the dollar, something almost exactly opposite began to happen. The dollar started moving onto crypto rails. Today, the stablecoin market is worth roughly $300 billion. And more than 99% of that value is tied to one currency: the US dollar, not the euro, not the Chinese yuan, not gold, the dollar. And that creates a strange possibility. Crypto may not weaken America's currency. It may become one of the most effective distribution systems the dollar has ever had. To understand why, we have to follow $1 from a bank account onto a blockchain. Imagine you give $1 to a regulated stablecoin issuer. In return, the issuer creates one digital token, such as USDC, that is designed to remain worth $1. The token moves to your wallet. But the original dollar does not disappear. It becomes part of the reserve behind that token. Some of that reserve can remain as cash. Much of it can be placed in short-term U.S. government debt called Treasury bills. So the machine looks like this. You deposit $1. You receive a digital dollar. And behind the scenes, the issuer becomes a buyer of safe, short-term American debt. The same economic value now appears in two different forms. You hold a token that can move around the world in seconds. The issuer holds the reserve assets that are supposed to let you redeem that token back into a real dollar. And the U.S. Treasury gets another buyer for its bills. That is the hidden connection between stablecoins and the national debt. Stablecoin issuers are not creating free money for the government. They are taking dollars that users want to hold digitally and placing part of those reserves into government securities. The larger the stablecoin system becomes, the larger this potential pool of demand becomes. Tether, the company behind USDT, has already become a major holder of U.S. Treasury securities. Circle's USDC reached more than $75 billion in circulation at the end of 2025. And in July 2026, Circle received final approval to establish a national trust bank in the United States. That does not make Circle a normal commercial bank. It cannot simply take your paycheck, open a checking account, and lend the money into the economy. But it does move stablecoin infrastructure closer to the regulated core of the financial system. This matters because the stablecoin business model is extremely simple and potentially extremely profitable. The user gets a digital dollar. The issuer gets the interest generated by the reserve. If short-term Treasury bills yield 4%, $100 billion of reserves can generate roughly $4 billion a year before expenses and distribution agreements. The token holder usually does not receive that yield directly. They receive something else: speed, portability, and access. And outside the United States, that access may be far more valuable than the interest. Suppose you live in a country where the local currency is losing purchasing power, the banking system is fragile, or moving money across borders is slow and expensive. Opening a U.S. bank account may be difficult or impossible. But downloading a wallet and receiving a dollar stablecoin may take minutes. That token is not the same as a deposit insured by the U.S. government. It carries different risks. But economically, it can give the holder exposure to the dollar without requiring a traditional American bank account. This is dollarization through software. And it creates one of the most important contradictions in global finance. Central banks may be slowly diversifying their official reserves away from the dollar. Some are buying more gold. Governments are building alternative payment systems. Politicians talk about de-dollarization. At the same time, individuals and businesses can be moving in the opposite direction. They may want more dollars, just not through the old banking system. Both trends can be true. Official institutions can reduce their relative dollar exposure, while millions of private users adopt digital dollars for savings, trading, payroll, remittances, and international commerce. The dollar can lose share in one layer of the system while gaining reach in another. This helps explain why the United States changed its approach to stablecoins. The Genius Act created a federal framework for payment stablecoins, including reserve requirements and regular disclosure. The political argument was not simply that crypto should be allowed to grow. It was that regulated dollar stablecoins could strengthen the international role of the dollar and create additional demand for Treasury securities. One high-end estimate from J.P. Morgan suggested that stablecoin adoption could generate as much as $1.4 trillion of additional dollar demand by 2027. That number is a scenario, not a guarantee. And even if stablecoins reached that scale, they would not solve America's debt problem. The United States has tens of trillions of dollars of federal debt. Stablecoins cannot make deficits disappear, eliminate refinancing risk, or permanently hold down interest rates. But markets often move at the margin. The important question is not whether stablecoins can buy every Treasury bill. It is whether they become a large, growing, and reliable new class of buyers, especially as some traditional foreign buyers become less enthusiastic about financing the United States. If that happens, stablecoins become more than crypto trading chips. They become part of America's funding architecture. But that also introduces new risks. A stablecoin is only as stable as its reserves, its legal structure, and the ability of users to redeem it. If confidence breaks, token holders may rush to convert their digital dollars back into cash at the same time. Then the mechanism reverses. The issuer that had been buying Treasury bills may need to sell assets to meet redemptions. A new source of demand can become a source of forced selling. We have already seen how quickly these fears can spread. In 2023, USDC temporarily lost its $1 peg after Circle disclosed that part of its cash reserves was trapped at Silicon Valley Bank. The peg recovered, but the episode exposed a basic truth. Putting a dollar on a blockchain does not remove financial risk. It moves the risk somewhere else. There is also a question of control. Dollar stablecoins can move without normal banking hours, but most major issuers can still freeze addresses, block transactions, and comply with sanctions. So this is not permissionless cash in the same sense as Bitcoin. It is privately issued digital money connected to the American financial and legal system. That may be exactly why it is useful to the United States. Every regulated digital dollar can carry American monetary influence into markets that traditional banks do not reach efficiently. The rails are new. The unit of account is not. And that is the larger story. The future of money may not be a clean battle between fiat and crypto, where one survives and the other disappears. It may be a hybrid system where blockchains distribute national currencies, private companies operate the interface, and government debt sits underneath the tokens. Crypto was supposed to build an alternative to the dollar. Instead, its biggest product may be turning the dollar into software. The dollar is not simply dying, it is changing rails. Don't follow the hype, follow the flow.